Greetings, market rebels. Welcome to this week's macro measure. It's Sunday, July 29th, and it's just a little bit in front of 11 a.m. here on the East Coast. I'm Wayne. Partner Ryan is working on our weekend outlook overview. So we're going to just flash a few things we need to take care of, and then we will get started. Here's our trusty disclaimer, and here is our trusty intellectual property rights notice. And then I'm going to bring up the stream, this week's stream, and just leave it up there for a few moments in case anyone wants to take a screen capture or snippet or whatever they call it, that little tool that Microsoft offers. But this is the stuff that I'll try to hit on. A lot of it's similar, but then of course it evolves from week to week. So what we'll do now is just shift things around a little bit, and then we will be able to take a look at some charts and cover these things sort of hopefully a little more systematically. So just bear with me while I reposition things and there we go, get this over on this screen so I can check it out. And then we will share the main chart screen, share number, screen 4. Yep, screen 4. All right, so this is screen 4. So I'll start out with this and then we'll get over to our stream points. But I think what we talked about last week, and I guess the first one on the stream, is that the most likely scenario would be they still try to run in the back half of July, but there is the RSI negative divergence that we need to be respectful of. And that, I think, played out. We came in, right, we had that kind of interesting holiday situation where we were going to get started, pause for a day, right, a half day on Monday, pause for a day, come back Thursday, and then come back Wednesday, and then finish out the week. And so when you look at this SPY move, they tried to keep things together on Monday, but then they started to lose their grip a little bit on Tuesday. Call it Wednesday, sorry. And then we finally came down here on Thursday, and things looked like they were going to bounce from that support line that I left up there. Potentially, and they did do that, but that bounce did close that gap. We were discussing this in Rebel Pit, so they took care of the gap right away, and then of course we had a very ugly candle to close out the week there on Friday. This is now above just right at the 10 SMA in white, with the 15 and 20 lurking in close proximity, so they're all right bunched up right near here, and I would have a line there, which I do. So I think really this would be for me the short-term trend. And so after you kind of have this double top situation potentially still with negative divergence, that's probably worsening, ugly close, and then you're still in extreme greed, which I should be able to flash, I think. Let's see, I think I have that up here. Yeah. So let's just take a look at that right now. And here you are. Oh, there you go. Little ad getting flashed on us, but here's the extreme greed. Now we did back off fairly nicely for the week from, I saw a high of 84. I don't know what they took it up to officially recently. Let's see, 83 it closed at, but I did see an intraday of 84. It might have hit 85 at one point. Can't remember for sure on that, but regardless, it did back off somewhat, but you're still there, right? And so if you look at the timeline again, you probably don't want to get too heavy duty on this particular sort of questionable construction here by CNN, but it is something we can look at. And you put a support line under here, you could be below there quickly, much like, here you start dropping below support and then it gets rough. You drop below support, probably right about there, it gets rough. I'm not really looking at it the same way I would in equity or an ETF, but I'm just saying in general, once you get up here and then you start cracking, right, you do get more typically once you've gotten that type of extreme push that we've seen. So the interesting thing, of course, would be that we've got the seasonality coming up where July, we're in that sweet spot, which we'll cover. And just to be thorough, let's cover some of the basic things, right? So here's the percent of stocks that are above the 20-day average. You can see that took a beating, right? That did start to correct. There's really nothing special to report here on MMFI, the percentage of stocks above the 50-day. Nothing special there, right? I don't think there's anything extraordinary to extrapolate from that, nor is there on the 200. So kind of muted, but there was, you could see in the short term, it because some stocks I'm sure had rising SMAs that got hit, and their SMAs, that 20 SMA had moved up more quickly as you would expect it to, then you did get a little bit more in terms of corrective activity there out of that. So the background to all this is probably worth covering. And let's see. So we've got, we did talk about continuing on. I'll just finish the points here, and then we'll get into some of our other tabs and keep rolling. But we did note that there could be some just end of quarter, Q2, halfway point of the year kind of window dressing markup. That's what the prior week that our thoughts generally were. And they played out, and then a lot of that air started coming out quickly. And they tried to reinflate things quickly on Friday, and that failed. And that's been really something that you haven't seen a lot of lately, really this year, where Friday is a rough session. But a couple of them have shown up recently, including obviously this past Friday. So that bears watching. I do think right at this point, with that air coming out, you're right back to where you were, right? So if you think, well, a week is 5 sessions, and we had to skip one due to the holiday, but if we still count 5 sessions, the close of the SPY was 438.55 on Friday. And on this particular day right here, which was, I think, the Thursday prior, it's 438.11. So you're changed from before the last minute sort of window dressing shenanigans really kicked into high gear. You're right back where you were effectively, right? But it's a little precarious, in my opinion, because, again, the negative divergence we cited, and the fact that you're not too far from breaking trend. Now, if you did break trend, I'm calling the 20 effectively the trend at this point in light blue. If you get that break, it wouldn't be that a situation where you fell for 6 or 7 sessions and then broke through. Well, that can happen, especially right if there's really just negative news developing day after day, or at least consistently. But the fact that you had a rally in place that kind of took off a little bit of the short-term oversoldness, that they sort of swung around on Thursday and then tried to play games with on Friday, that sort of freshens it up in terms of a cycle in my mind. And so that's why, to me, it's no joke that we're very close to this critical short-term support. And so if that breaks, and I would say there's a pretty decent chance, which is why I'm taking it to Defcon 2, I think that it makes a lot more sense for the gang to put together, if they're going to have some corrective activity in front of the earnings releases as they start to ramp up, early in the month would make sense to do it. And then as we get the engineered beats coming out, maybe starting this upcoming Friday with some of the financials, who knows? But regardless, if that's the typical game gets played and we get these engineered beats, that would allow them to sort of get another leg back up in, using all that as their propellant, right? So in front of that would make sense to correct. It's just kind of like keeping that calendar in mind. Now, I do this every week. I'm always thinking about it, but I don't always talk about it to the extent that maybe I am right now. So I think that's a very strong sort of intermediate term likely scenario. But again, right, you got to, if the markets teach you anything, if you manage to stick around long enough, it's that you need to be very adaptive. You really need to be nimble. You need to swing around quickly. I was willing to be a bear on Thursday in some energy names when we saw a lot of ostensibly bearish paper, and then flipped around on Friday because of how energy reacted when we saw bullish paper. So I just think, right, you've got to be able to do that, because news can change things in a hurry, right? And different factors can start to matter to the market in a very short period of time, and the market starts pricing things in. Some things it ignores, and then some things it prices in pretty quickly. But my target would be, if this corrective activity does take hold, I think it makes a lot of sense to go back to our sleeper scenario breakout point, where you get above that 432, you put your pop together. They brought it back down to here, right, and held, right? That's the nice, breakout, find support, right near that 432-ish level, 431, 432 level we talked about for most of this year. And then they managed to put this rally together, right? So that's already kind of proven itself that it was formerly resistance and now maybe could be supportive. So I do think, right, another test of that would be in order. And we're not really talking about a massive move. I mean, it's probably at this point, it's actually less than a 2% move. So it would, if we got a 2% move, I guess we would kind of get a little bit below 430. But I think that 429 to 432 sort of zone is where this would likely go to if this correction starts to really take hold. And let's look at a longer term view, so you can see that if you're new to the sleeper scenario that we've been talking about for a while. But that has to do with this high getting put in back in here of 431.73 back in August. And so my way of looking at things was that that's a great example of a peak in the chart that was made during a corrective phase that would really bring about sort of a capitulation from some shorts and from some reluctant bulls. And that could draw people in on a bull trap scenario. And that's why this is really the window's really closing on that sleeper scenario possibility. That, again, it feels like we've been talking about it for longer than we have, but we probably have talked about it for 5 to 5.5, 6 months at this point. Just as something that came up once the market started rallying, what could they do? And that would be, for me, a big deal, because it's one thing to kind of start making new highs against these lesser highs that are down here, part of this downtrending structure that went from AUG till OCT, where the real bottom got put in. That's one thing to take some of those highs out, but this is really, right, part of your overall broadening wedge formation that was in place all the way down pretty much. And to me, that's sort of a real telltale sign, like, hey, this thing's really emerging. And I think a lot of people maybe were holding on against that. So I do think a lot of people have gone into this market. I think it's been premature, but that's always the case, right? I mean, I've always had that feeling. And a lot of times, right, when there was another leg to the bear market, all those FOMO players really get doubly smoked, because they have stuff they never got rid of in the first place, and then they add to it, and then it becomes pretty ugly. Again, that's very tough to call, and not really what I'm trying to do here on a week-to-week basis anyway, but it's just something I thought that was worth mentioning. So double top possibly is not a pattern that I ignore all that much. I think it's an important pattern, as common as it is. Double tops and double bottoms are worth watching, in my opinion. And I'm not really all about patterns, but I do think patterns matter. And I think some of them matter more than others. And I think the ones that do, the ones that have been played out well in testing over decades, and that they also appear very somewhat frequently. Those are the ones I think are worth looking at, because you'll see them a lot and they have a high rate of success. So I think double tops could be one. This isn't something where I'm making a crash call or anything like that. I'm just saying that the short-term trend would really be under pressure. This could fall all the way back down to the upsloping, right, the rising 50, and still really hold the trend, even though it would get below that critical level we've been focused on for a while. I mean, all your longer-term SMAs are rising, so there's really not a lot there to say, oh yeah, if it just cracks this or this, it's over, it's done. It could be. In retrospect, it could be, but I don't think I would go into crash mode. I'm calling it Defcon 2 right now, just because you're so close to critical support, and the calendar, in my mind, makes sense to correct soon. You're still in extreme greed territory, and there's still a lot of complacency out there. All you have to do is look at the VIX and things like that. Now, the other reason I'm a little concerned too right now, more so than I've been, I think, in a while, honestly, is it's probably been months and months at this point that I can recall. I don't remember feeling this close to a concerning, worrisome situation for a while. But anyway, I think this is the big story that kind of got put off the radar. would be one way. And I think a lot of people have just kind of fallen asleep on the fact that the big story behind a lot of the initial part of this rally was that not only would the Fed pause, but they'd be cutting soon. And it seems like an eternity ago where they were starting to chit chat about that. The usual, permeable suspects were doing that talk on Fin TV. I'd say late in the winter time, right as the winter was sort of rolling out and spring was rolling in. And I remember hearing some comments that they even expected at the May meeting that the Fed would be cutting. And I didn't understand that. You just never know, because there could be some really bad news developments that I'm going to start to force the Fed's hand. So that's why I rarely say never or always, right? Because you just never know for sure. But I really had a hard time understanding, other than really cheering their own book on, right, why someone would make that argument. I didn't see inflation peaking in terms of like it's peaked and gone down like dramatically. Sure, it may have peaked out, but it's still not down enough, to really be in a healthy range. And I also believe that it's understated, and I really have a problem with the fact that so many people refuse to look at the reality of where inflation really is and just talk about the phony inflation that the authorities put forth. No one wants to talk about reality or truth. The truth is the last thing they want to deal with. But even at the government statistician level, inflation's still high. And so if you look at this, right, there was a big move here in the last couple of weeks in the 10-year yield, and you're back above 4%. Now, this was an area where it struggled and retreated from. Maybe that will happen again. I can't say. But if you look at this, right, you have a rally here, then you have this consolidative action, then you've got this higher low that gets put in, then you start making your move up. And so I don't think that should have really come as any surprise, especially with the Fed watch tool, which we show here week to week. And in fact, let's look at that. It's probably going to cover one of our points, and that should be right. Well, I thought I had that. This is what happens when I go from one thing and don't stick with it. I'm pretty sure I had that, though. I'm not sure what happened on that one. Let's remember where we are. That's not it. Okay, it's got to be maybe membership. Yep, maybe membership. I thought I left it on Fed Watch, but I didn't. But here's the Fed Watch tool, which we've been checking out every week. And at this point, things can change, right? But you're about 2 weeks away pretty soon from the next meeting, and there's 93% chance you're up from there. And I think, okay, that's fine, but this to me is the more concerning thing to look at by the end of the year, just to kind of say, okay, what happens by the end of this year? Well, there's a chance, about a 90% chance you're up 0.25 or higher, right? About 89% roughly. Okay, so pretty strong, could be even up twice from where we are now in terms of 0.25, then another 0.25. So this doesn't show rates trending the other way, the way that we've been told by all of these people that this scenario, that scenario really has had the legs cut out from under it. So when you start adding it all up, I think this is a problem, right? I really do, just because I think this is going to crush durable goods. If this really happens this way, I think it's going to crush those durable goods purchases and housing. So autos and all those big ticket things and housing, I just don't know how it becomes affordable with rates even higher and with housing prices having gone haywire due to many factors, but certainly due to inflation. So this is really, really I think a recipe for a disaster. And so people that are cheering on the fact that that we're going to come in at a 1-point-something% GDP growth for the second quarter is what people are talking about now. I'd rather see it lower and get the Fed off of rate hikes, because I think the longer they do this, the more risk it poses. I mean, in terms of a greater correction in terms of magnitude and duration. So that's just me kind of like armchair economist, but That's just my general take. It's been my take really the whole year. But this is exactly why I don't trade my take. I trade, what the market's telling us through the charts as objectively as I can. Just a reminder, because these are some of the other points on our stream this week, and you've got the VIX seasonality, and you can see, right, that you're really getting close. We don't have it updated to this point because I haven't seen another tweet from Zero Hedge about this, but and I don't have seasonality data, unfortunately, that I can flash from my own systems. But anyway, you've got this situation here where look what happens to the VIX, right? So again, this is something that we talk about in the Phoenix portfolio service the most. So we've covered these things. Let's cover something that, one thing this week that really caught my eye, and these visualizations can really, really be helpful. So I saw this tweet, and of course I clicked on the link to see what it was all about. And what I wanted to show was, if you look at the office space that's out there, there's 1 billion square feet of empty office space in the US. So if you look at a floor area of 20,000 square feet, an 11-foot ceiling, this is, I guess, what they're basing this on in terms of what an office building would look like, right? Just to give you an idea, here's Mount Everest. This is Washington, right? This is New York. And if you look at some of these things, these vacant office spaces between New York, Chicago, Dallas, and Houston, that would be, it would reach past the stratosphere. So basically, right, if you just take those cities right there, you're already here. And that's dwarfing, right, weather balloons, Mount Everest. It's dwarfing, more than dwarfing. You'd be basically leaving the stratosphere, I think. So you're way higher than, of course, the airlines fly, that whole thing. But the real number is, up here, just to give you perspective. So again, I don't know, that's higher than the Aurora, but I don't know how people are just sleepwalking with this kind of an issue and what that could create, I think, in terms of fallout. But yeah, that's me. I just feel like, look, there's a lot of things that are like higher rates, this office space issue with all these potential for default, housing, which at some point I think is likely to top out because mortgages have become so much more expensive than they were just a few years ago. I mean, they're just so much more of a challenge to service. It's really remarkable. But another thing that we should probably hit on is look at this trend of sentiment, right? So now this again is, remember, contrarian. So for the 5th week in a row, the sentiment is above average. And you could see that here's your historic average. Your tip, so you're quite a bit up there, right? You really are right now. You're nearly 10% higher than your historical average, which, as you could see, tends to be bullish. And this is that 1-year high as well. So this is contrarian. And so that's another reason why, with everybody now flipping the other way, we've been talking about how the price changes can ultimately affect the sentiment in the market. Well, there's the proof is in the pudding. The market's done very well to start out this year and really to finish last year from the lows. And that this has changed the minds of many, right? So just keep that in mind. And here's the final reminder. 3rd year of the presidential cycle. We've been talking about this, but we have to just remind everyone, because I don't want to reference something and no one really has a clue that's never watched the videos before, excuse me. But then you have the next couple of years, right? In the finish of this year tends to be rough, but then you kind of pull it out with another burst at the end. And then next year tends to be the election year, or the presidential cycle tends to be the second best year. But this year, right, we would expect that after we hit that sweet spot, and the sweet spot is right here on our newsletter, and we've been putting this in for a while, but the sweet spot is right here, right? And it kind of ends with July. And July's been a really good month for the market. So you just can't rule anything out, right? Like I said, I think it makes the most sense to correct sooner rather than later, and then try to rally into month's end like they typically do. And then, you use those earnings as the propellant, the fuel to justify what you've just done in stocks. And it's in the face of a lot of, I think, deterioration that's being ignored. And that's the way the game is played quite often, though. So just remember, probably right when we get to the high point in July, we probably are in store for some ups and downs for the next couple of months. So, right, this is probably has a lot to do with the old adage of the old sell in May, go away, because right, you usually, this is prior to when that was really made popularized, I should say, that was probably pretty true. But if you sold at the end of May, I think you were better off holding from Nov through May, as opposed to June through Oct. You know, that this kind of shows you why, right? That not this particular year, but just overall, right? Where you just kind of get that middle of the year performance. It's nothing special. And most of your gains are had around that, essentially the other months. So that kind of brings us to through a lot of things on the stream this week. So I'll get back into the charts. And I just think that if we step out and step back, and this is something I really like to do, but if you bring this into focus, and I adjusted some of my support and resistance lines to really try to get a better visual on this channel, but I really like a juncture like this, you know, as a bull, right? I'm not an interest rate expert, and I'm not forecasting that, but I really like when there's been the strong run and then there's been an extended correction, and I come to the other side of my channel, I find support there, I dawdle, and then start breaking out, right? And so if you want to go back and say, well, let's look for an analog or something, you know, you could see that it's going to be a little messy here, so bear with me. And that's too messy, so let's get less time. Let's just do it on the weekly. Probably the 3-year weekly is better than what I'm showing there anyway, to kind of demonstrate this point. And I might need a 5-year weekly, so let's see if I can get that 5-year weekly. And then you could see that, because right there, if you correct and you come into this, you know, and you're down near the lower part of your channel, and then you start to go from there, you get this really nice run, right, that follows. And you even had something like this when the initial kind of boundaries of the channel were being formed, where you kind of brought yourself down. You came down to here, and then you could see what happens, right, once you go from the top side to the bottom side and then start to rally. So this is a really nice long kind of basing formation within this upsloping channel, and it's really close to, right, eclipsing that high, and then that these would not be too far away. And if it eclipses those, right, and you just kind of extend the trend, it goes much higher. So this to me is concerning. You know, I just don't, I feel like those rates are being ignored. I think a lot of this is shenanigans, chicanery. I don't think things are as good as are being reported. It has nothing to do with one administration over another. For people that think everything's political, they all do it. I don't know who's the most egregious. I'm sure they're all pretty darn egregious, but I just feel like there's been so many head scratchers. A lot of this data, I just have a really hard time with. And I think it's masking issues. And with that being the case, right, that's what sets up for potential large dislocations, where suddenly, right, the market completely falls apart because things were misrepresented. People bought on misrepresentations in a big way. And I think they've committed huge to this rally, thinking that was it, that 2022 was it, and that bottom is it in October, and we're done, we're heading higher. We very well may. I don't want to act as if that can't happen. It certainly can. There's a lot of talk out there that there's stealth hidden, you know, support from the Fed that's still going on. So meanwhile, they're jawboning about this, that, and the other thing, and making it difficult on consumers with their mishandling of policy, where they create inflation, then they combat inflation. Of course, this has gone on for so many, I guess, 100 years since the inception of the Fed, 100 years plus. But this is what they typically do. And so they create inflation, then they raise rates, and it kills people that, you know, that are struggling, and causes all kinds of economic fallout for people without deep pockets. And then people with deep pockets, they're not as affected, nearly as affected, and they come in and scoop up assets, and then the Fed inflation cycle starts all over again, and they They do very well. It's a game that's been played for centuries in different ways in different places, but that's not really news. I'm just saying that to me, this is concerning. If this, I would keep your eye on these yields. If this thing continues to power up, it's just not good. And I don't really care how much they want to pretend that this is not a problem. You know, I'm pretty steadfast in saying that they keep taking rates up and inflation continues to not be completely quelled. This is just a very problematic situation. It could create a big problem for the market. Not that it will. I just think it really lays the base for big problems in the economy. So let's go through and make sure we've got everything covered. So I think we talked about it, the sleeper scenario, VIX seasonality kind of starting at the top of the stream. The strong first half does augur well for the second half, though, right? So, and you saw the presidential cycle, the sweet spot. So you shouldn't have, maybe you won't have the rip roaring upside that we've had in the first half, but ultimately, right, this kind of performance in the first half has typically led to a solid second half. We did see the rate hike probability is now at 93%, even though the third year of the presidential cycle is still clicking. I do still think there's room on the charts for stocks, right? If we go back, just look at the SPY, you can't say that, no, this is completely over. The bear markets are about to return, in my opinion, yet. There just hasn't been enough damage, right? Now, stories could develop, whatever, but I think this is just the cracking of this initial trend. I think to really feel like you're getting there, you'd have to really start to see some of this kind of like cluster of lows versus this single low. It's sort of a double bottom situation. And I think we may have talked about it at the time, like how it was a wide double bottom, but two different kinds of bottoms. And then you get this pop, the consolidation, and then naturally you break out because you consolidated and you remain near resistance and you were able to break out easily and go. And that's what they've been able to do. But I do think the short-term trend is under pressure very quickly with any weakness. So remember, just while I'm on this, remember, they can bring a lot of new shorts out of the woodwork if they drop this thing below the 20. We're not the only ones watching it. Now, does that mean you don't trade it if you think it's going down? No, you just got to be on guard for that. If it doesn't just immediately start descending, they could put a little bit of a drop and then work it back up to the underside of that support line at a higher place that would stop a lot of fresh shorts out and then let it go. So I'm just mentioning that. In fact, while I'm at it, let's just mention that it doesn't even have to crack, right? It sounds like I'm saying I kind of know when I'm going that way that, hey, thing's about to crack. I think it's got a good chance to. I don't necessarily think that it definitely will. I have no idea what news will come out over the weekend, right? And what could impact things by Monday morning. And at this snapshot in time, I think there's a decent chance that this cracks. And then you start to see more downside, but it's really the path that it takes, right? If it just keeps going and you trade to that breakdown, awesome. But if they put a little, just don't get caught, right, with everybody else. If they put a little scam together to chase everybody out, then fail later on and go. I don't think the breakdown, come back up scenario is super likely, because I would think if they're going to get this ugliness over with sooner rather than later, they'd want to just break, go down, and then use those financial earnings later this week, and then the earnings that follow following week to start moving things back up. But again, you never know. So just keep that in mind. So let's see. Let's make sure we make it through everything before I finish out on the charts. So the gang, again, I think we're at Defcon 2 because of all the things we just discussed. I do think that we could be in for some rough and choppy stuff until the earnings really start to dominate the news. And that could be in a couple of weeks, even though we're getting some later this week. I do think the gang really still believes that the inflation will be passed on to the consumer. And because of that, some of these stocks are going to see, so-called beats that they seem to engineer virtually every quarter. I do still think that we should remind ourselves that I still think there's a lot of money that flowed into these markets, and a lot of it could be trapped if they realize that they're Goldilocks stuff they were pushing, that story is really not there anymore. Right? It holds no water anymore. So I think they front run the recovery. The rates peaking story is done. That fantasy was strong in Q2, but it's over at this point. I don't see how anybody could make that argument. I mean, at this point, given where the expectations are, so on and so forth, I still don't see great stuff out there. I don't think that the international situation looks very good from what I'm able to gather. I think that that's a problem, right? Because there's so much trade that goes on, and if a lot of your key areas are retrenching, I don't see how that's a good situation. But again, a lot of people are talking big stuff, but it seems like they always do. I'm still leery to buy into the all is well argument. I won't rule out Beats Euphoria. That's something you have to, where I think they could really exclamation point things with one more leg on like a series of beats, and then that would be probably where you neutralize a lot of your long side risk if you're still in. Let's see. Anyway, yeah, I don't need to go into the AI. I just think that a lot of these big stories are masking the Main Street issues, which we've talked about. I do think there was, a lot of FOMO. I do think there was a lot of arm twisting. So a lot of people just reluctantly had to start buying, because I think that's what happened with a lot of the sectors where we talked about the sectors like having this really strong surge. I think those spikes were all about the end of Q2. Not really this legitimate buying. We'll see, right? Because this week, if everything starts to go risk off, it'll sort of be somewhat proven that, yeah, they probably just goosed them to make things look better than they really were, which is what they do all the time, which is why the whole window dressing discussion comes up all the time. So I still think, right, that we have that the divergence is still there. We have to be respectful. I talked about the durables and December's rates already. I do still think they're going to try to make the most out of the sweet spots twilight. So with the sweet spot on its way out, I think you need to be ready for that. The bottom line for this week, again, the sleeper scenario is activated. We talked about that earlier, and this is really its time to shine. I might give it a little more time. Like if it does start to fall and gets down to here and this doesn't hold, right, some of these other technical areas below the sleeper, then maybe this takes on more of a life of its own. I don't know. I mean, I think if rates continue to head up, I don't see how the market just doesn't react to that finally. But I do think there could be more to the sleeper scenario, really cracking things. But I'd rather, as I almost always say, I'd rather do it incrementally, right? I'd rather wait until we see a key level. First of all, the sleeper scenario, 432, 430 to 432, 429 to 432, that would need to be kicked out. Then you've got a flat line right near, say, 426. Then you have a possible gap fill. There's the 50-day. I think all these things are possible, especially, right, if we have a rough week, they try to rally into the financials earnings, and then they don't play out very well, and things get walloped even further. Certainly could happen. But if the sleeper scenario doesn't start to produce something, it kind of did finally, right, where this week we kind of are now at this precarious point. But I wouldn't give it much more time, right? I think it's got to do something within the next week, and maybe I'd stretch it even a little bit further. But it's probably needs to have a rough week to really start playing out. Otherwise, right, if they hold things and so on and so forth, it could still be more of a complicated corrective activity up here that ultimately produces maybe like a head and shoulders or a triple top or something like that, or a triangle that ultimately gets wrecked. But at this point, I'm thinking it has to happen sooner than later still. So let's see. Yep, so Defcon 2, and it's, again, review on that is 20 days right there. You may as well call that your support line. You've got that. You've got the extreme greed still in place, the 10 years moving up, Fed watch tool. I think things could escalate to Defcon 1 quickly if this thing cracks. So just be ready for that, because that could bring about another test of that sleeper scenario breakout level, which was right, I'm just ballparking it at 432. But I still think, right, I still think the FOMC and the earnings situation that will start playing out more heavily as the month draws to a close are probably going to have the final word on this whole thing, barring, of course, major, massive, news developments. Double top, right? We can take a look at that in IWM. So that, to me, right, you've got to be a little concerned about that, the way that it's acting, but there's a lot of support, right? So probably wouldn't worry about very much until that 50 in gold is under pressure, and that's down at 179. So that would need to fall, nearly 3%, roughly in that ballpark, before I'd say, this is really in trouble, and then we're on our way back down. But I don't think this is a good look for people saying that the small caps are all going to start joining things. They tried, and it's yet another failure. And now they're really lagging behind something like the QQQ, which is coming, really coming off of super high levels and wasn't even that far from the highest high this week. But once again, if you look at this high and you look at the negative divergence there, you've got to be concerned about that if you're a bull, right? If you're a bear, you might finally be happy. But remember, a lot of bears are waiting for their moment, right? And so if we find ourselves being one of them, remember that these guys are great at the market will often do what you expect it to do. It just takes a different path than you expect it to. So that's how you can still lose, even if you were ultimately right. So just be careful. Again, it's all about, comes back to discipline. Get the breakdown trade started if you think it's there. But if it doesn't materialize, then you've got to be able to be ready to take the loss, because you're trading against long-term trends that are strong. But we do, having said that, we have to acknowledge that there has been a crack, right? There's a crack in the armor here, and there's a chance for these bears to finally maybe have a few moments of enjoyment where they've been mauled for a while. So let's see. With final one, we'll do the diamonds. But I think the big discussion really is what we talked about with TNX. Diamonds too, with that little mini double top, kind of worsening, worsening technicals. But again, there's a lot of support underneath here. And that's another reason why when I looked at everything, I'm not calling for some kind of a crash, just because we finally have some weakness here or there. I think it's until you really break something, again, bigger, I wouldn't get too far afield on that. I think the 200 down there in purple, that would be a big deal. But even so, there's probably decent flatline support right around that 327, just give or take. So it's supported in there. It's respected that level a couple of times. I would expect that that even to be the case. So you really need to have lows get taken out and think that there's possibility for a continuation beyond that to really say, yeah, this thing's completely over. But as of right now, the charts are still mainly in favor of the bulls, in my opinion, in the big picture, just because enough damage hasn't happened yet, right? Things do flip fast though when they do. So this could start to flip around quickly, but as of right now, you only have a little bit of problems on some of your lesser charts, your short-term daily charts. So that's why I wouldn't get too bared up yet. I think the smart move is, if you do feel like something's coming sooner rather than later, is get yourself positioned properly in terms of being long implied volatility in the right places in time as well. Probably DXY, this thing started to make a move, but then the DXY got rocked on Friday. That of course helped out. That helped, which we'll cover in sector situation. The dollar, going down, that helped out. It seemed like it helped out oil a little bit. Hold on, let's see if we can get this to come up. There it is. So it helped out a little bit. Oil had I'm getting into the percentages again, but I just wanted to show the action here, that you're getting a nice little, it had put something nice together for a change. Still downtrending, right? Still has more work to do to really break free of the hold of the downtrend, in my opinion. But it certainly was a little more constructive. It did take out a short-term high. And you could sort of see like this low here versus these lows here. you can see that the RSI right there, it was a little bit better of a reading. So there was a little bit of positive divergence there. Again, something I think worth noting. So I think other than the VIX, I think I'm going to wrap there and talk about everything else and sector situation. But as you know, as they often do, right, the VIX was on its way and they really clobbered it, right? Friday was an ugly, ugly day for the VIX. And even though the market got rocked late in the day, and that candle in the SPYs is as ugly as it is, and the trend is so close in proximity and could be broken easily, ultimately that didn't matter much to the VIX, which was down pretty decently on the day. So again, in front of a weekend, it's not a shocker. It's certainly not a shocker with the way these guys have been kind of mutilating the VIX on Fridays, just and end of week, just to keep good times rolling. So that's not a shocker, but it's getting down towards levels. I mean, you're not that far off of the recent lows, which were just a little bit below 13. But this is, of course, not something you can chart like a typical equity or an ETF, but it is worth, of course, keeping an eye on at the same time. So I think a lot of the selling was pretty serious that we saw on Thursday and then late on Friday. I don't know exactly what it was all about, if it was finally just the reality that maybe this whole rate story is done and that the 10-year rate is now back above 4%. I don't know. I'm really not positive as to what really drove this. I didn't see anything on it yet. I do plan to do some more reading, but regardless, it was an ugly finish to the week, and I think you really have to be at Defcon 2 in terms of the short-term developments because of that and because of the proximity. I just think you just don't want to see your week close that way. That's really a complete reversal of fortunes from where it was, where the SPYs were maybe sort of midday-ish. Even I think maybe into it might have even been into the afternoon that they were still okay. Ugly finish, negative divergence, double top, and a lot of air down to this gap fill potentially, which would be even further of a corrective activity. But I think you have to be on guard for that. And I think if it starts cracking here, you're at like DEFCON 1.5, and then if it really cracks here, and then ultimately here, then you'd start getting into bigger thoughts of, man, this is really taking on a life of its own. I don't know if that'll happen, like I said, because they've got catalysts they can use to trade around that would probably have hope springing eternal all over again. And that's the way that the crowd likes to roll. But at the same time, you just never know. So be on guard. And as long as you hold trend, you're going to be okay, right? You'll probably try to fight your way back up, and we'll see what happens. But I think you have to be ready for a breakdown and possible rough chop over the next week plus maybe, especially if the earnings aren't received well. We'll see what happens. But on that note, I'm going to wrap it up. I'm going to thank everyone for tuning in. Hope something I share with you this week helps you out this week or sometime in the future. And I'll see everybody through the webinars and updates and summaries and next week's videos. Thanks again.